All right. It looks like from my team in the studio are telling me everything is going okay. I'm sorry I'm backwards. I'm not sure how if I can fix that, but it's okay. You can still tell who that is. That's Frank Zappa, one of my favorite musicians. And what he's saying there is a mind is like a parachute. It only works when it's open. So I would encourage everybody to be open-minded about our discussion today, which is going to be about the biggest threat to the stock market right now. Or biggest threats. Now, the way I want to do this is I would like you to send in questions on the chat feature here. My team is going to be looking at the questions and they're going to vet them, to be honest. Mainly because it's very difficult for me to pick up everything. I see stuff coming in over here. Thank you, Lighthouse Capital. You tell me that I'm actually not backwards. That's good to know. But basically, the idea is we want to drill through to some. Really, I want you to tell me what you think are the biggest threats to the stock market today, so that I can basically tell you what I think. And I want to do it that way. I want you to pose to me what you think are the biggest threats to the stock market, so I can respond. Because there's a couple of predictable ones. There's inflation. There's Fed tapering. There's a government spending, some people say. There's the possibility of a dollar collapse, and so on. So what I'd like to do is, get your views of it. Now, I see one that's come in from Final, who says politicians and the Fed. Well, you'd have to be a little bit more specific than that, I think. In what way are they a threat to the stock market? Is it taxation? Is it the withdrawal of tapering? Is it printing too much money? Whatever. Okay, so now we have Sharat saying treasury yields thinks are the biggest threat to the stock market. Well, let's take that one as the starting point. I think that's probably one that a lot of people have been paying attention to, certainly this last week, because we have seen a spike in the 10-year yields, particularly in the 5-year yields. They jumped up pretty rapidly. Now, why do treasury yields matter? Well, first of all, treasury yields matter because the long-term profitability of an investment in a company depends on the discount rate that you apply to its future earnings. Now, obviously, if the treasury yield is very low, that means that interest rates across the economy are very low, which means that you can't get very much return on any investments that you put into fixed income. That means that even if income is likely to come from a company far off in the future, it's worth more than it would be if you could get a good return on, on your just by putting money into bonds and whatnot. So that's the theoretical reason why treasury yields matter. But I think there's a much bigger reason for that, and this is one that I actually want to try to dispel. Now, the classical argument for why rising treasury yields matter is because they set the benchmark rates for interest rates across the whole economy, right? The idea being that if you raise interest rates, you'll basically make investment less profitable, because any investor is going to take a particular investment opportunity and they're going to measure it against the risk-free cost of capital, which is basically the interest rates that they're facing. Now, theoretically, if you raise interest rates, that means that companies are less likely to invest, and therefore that slows down economic activity. It leads companies not to invest. It leads them not to hire, that sort of thing. Unfortunately, the actual evidence for that is not very great. And the biggest issue is that companies invest really based on longer term considerations. Particularly, they invest on their expectations of whether they can sell their goods and services into the market. So paradoxically, with some exceptions like the 1970s, you don't see a big pullback in interest or business investment just because interest rates tick up a bit. On the other hand, the impact that you can see from the impact of interest rates on investment horizons, people's thinking about where a growth company, to pick a company out of a hat, a company like Zoom or Tesla or whoever, who you're expecting to see earnings in the future, that has a huge impact. Now, the next question is, what would you expect interest rates to do? Do you expect them to rise? And what would be the reason for that? Well, one of the reasons that we expect interest rates to rise is because if the Fed stops buying treasury bonds out of the market, which it has been doing for the last decade plus, particularly since the Corona crash last year, that means that all of a sudden there are more treasury bonds in the market than there were previously. In a sense, the treasury was, or the Fed was taking that supply out of the market. And all of the things being equal, the fewer of an item there are in the market compared to a fixed number of bidders, the higher its price will go because it's more scarce. So if the Fed stops buying these things, i.e. if it tapers its purchases, that should cause the price of treasury bills to fall, which would make their yields rise. Now, question is, does that mean the entire stock market crashes, or does it mean that certain sectors of the economy or the market pull back? Already, we've seen in the last week or so that the threat of rising, well, not even this week, going back to the beginning of the year when we had the first interest rate scare, the first inflation scare, we saw that the impact on growth stocks was immediate. And it's because of that discounted cash flow stuff. The question I want to ask, though, is what would cause interest rates to rise to an unacceptable level and what would keep them there? And I think that leads us to the question of prolonged inflation. I see coming from Jordan Chan. Jordan, I think prolonged inflation, in fact, I was just thinking about that, kind of rehearsing for this just before I started this stream. What's likely to cause prolonged inflation? All right, and I'm going to circle back to the question of interest rates because ultimately a rise in interest rates that is sustained as opposed to one that's caused by slowing down tapering, which I think the market has priced in, that would have to be caused by something. You'd need a catalyst. So what are the catalysts for prolonged inflation? So let's take a couple of examples. In fact, I talked about inflation in my last live video. One is that if you have a small economy that is closed for whatever reason, it imports most of its business goods and its wage goods and so on, and local people, pay for things in their own currency, you can have a situation where the government prints a lot of currency and that causes prices to rise. It happened in Weimar Germany, it happened in Zimbabwe, it's happening in Venezuela, we've all seen those. That has absolutely nothing to do with the United States. And people who tell you that are really, they're just blowing smoke out there, what. The bottom line is that sustained inflation comes from a combination of the supply side and the demand side. Now, when you talk about inflation, you're really talking about two things. One is a rise in the prices of an individual good. If oil goes up, as it has done recently, that means the oil price is inflating. But what we really care about is inflation across the board that is sustained. You have a basket of goods and those prices rise continually across the board, enough so that they affect a wide part of the economy, not just one part like energy inflation. Now, to see how that could cause a problem for the stock market, you have to divide things into three categories. Any economy fundamentally has three classes of goods. You have business goods, which are the capital goods and raw materials and other inputs that businesses use to create goods and services. You have consumer goods, which is the stuff that we all buy, and what we consume, food, clothing, etc. And then you have labor, right, which is the critical input. Now, in the 1970s, as I've argued in my last live video, labor was the big problem. It started out with a price shock that came from the combination of the Nixon administration ending the convertibility of dollars to gold, and then the Arab oil embargoes starting in 1973. Those two things caused a short-term price shock, but the critical catalyst was, or the transmission for that catalyst rather, was that in the United States, most major manufacturing industries, which supplied the bulk of U.S. goods, because in those days we still made things for ourselves at home, they were highly unionized, and those unions had what they called cost of living agreements or COLAs. And when they saw prices rising thanks to these external catalysts, they demanded and were able to achieve, thanks to their strength, that employers say, all right, well, we're going to increase your wages by X next year. X being to keep up with inflation, plus enough to keep a rise in your real earnings. Now, obviously, in a situation where you have an energy shock and prices are going up across the board, you add on top of that the ability of labor to drive up their own wages, and those have to be passed on to everybody else in the economy. You get inflation, and that's precisely what happened. And it only ended when Chairman Paul Volcker decided in the late 1970s, early 1980s to basically use that the Fed's interest rate setting mechanism to squeeze business activity in the way that I just described, make it too expensive for businesses to justify investing. Make the short-term return on treasury so high, double digits, that it makes no sense to invest in the real economy, and that forces everybody to stop. That forces the unions to back off, and that's exactly what happened. Question is, what are the sources of inflation now that are going to cause the stock market to crash? Well, the one that a lot of people talk about is too much money chasing too few goods. And I talked about that last time. And I said, my view is that that's not the problem that we have. First of all, most of the Fed's quantitative easing doesn't end up in the real economy. It ends up in the financial economy. It ends up really in the sense it's a swap of treasury bills from banks and other institutions to the Fed that gives them cash in exchange. That cash doesn't go out into the real economy for the most part. Instead, it helps to keep interest rates down. And that's what drives interest in the stock market. Now, as I said earlier, I think that if the Fed were to taper, that wouldn't have a huge impact on the market except for growth stocks. Of course, to the extent that those growth stocks are the leading edge of the market and have been for most of the last year, yes, that would mean a pullback in the overall level of the index, but it wouldn't necessarily mean a collapse. Now, that is a threat, I'll grant you, and that is what we're talking about today. So yes, rising interest rates are a threat. But the bigger question is, do we expect to see sustained inflation, and is that a threat to the market? Here, I side with the people who cite supply chain problems. And in a video a couple of weeks ago, I went into detail about that and explained that a lot of the supply chain problems that we're having right now, including for things like lumber and beef, for example, semiconductors, all of these things go back to issues of lack of competitiveness in the markets that the markets for those kinds of goods. So that brings our attention to the business goods side of the economy. And there, I think what we have is a situation where we lack resilience. We don't have enough different types of supply. We don't have enough options for the kinds of things that we need. And what we've seen now is that when there's a disruption to the supply chain, those things go up. Question is, why should we expect that to continue? I think that it presents a business opportunity. We've seen, for example, Ford recently announced its big plan to build battery manufacturing plants in Tennessee and Kentucky. And they explicitly said the reason they want to do that is to get away from the supply chain risk. So there's an example of a company that's moving ahead to try to head off that risk. Now, you multiply that across different sectors of the economy, and with the appropriate policy support, in other words, if you get the government's, encouraging companies to do this kind of thing, that inflation should go away. The key thing is we just don't have the labor movement we used to. What we have, right? So you can't expect unions to drive prices. What we are seeing in labor is that a lot of people are reluctant to come back into very low wage jobs because of the risk of COVID. And for whatever reason, I don't think it was because of the payments they were getting, the support payments, but whatever reason, a lot of those people are staying out of the market, particularly women because they can't get childcare. All that kind of stuff adds up into a short-term shortage of labor. That, I don't think, is a source of sustained inflation. The only way that could happen is if we saw a real political change in the United States. So my basic message here is I don't think interest rates are likely to be a barrier to the stock market continuing to grow. The biggest question, I think, is something that somebody mentioned earlier, that Gary Cook, my friend from Eugene, Oregon, says investor attitude is one, and Lighthouse Capital says leverage, those two. So let's talk about those two. In fact, I prepared a lot of stuff for this chat that I can't show you because unfortunately, next time we'll have this sorted out. But right now I'm not able to show you my own screen, but I just wanted to, refer to a couple of things that I'm looking at on my screen. Now, one of the things that I pulled out was a chart of the South Sea stock bubble, which happened back in the 18th century. And I did that because I recently wrote a report about that, and I talked about the mechanics of stock bubbles. And that goes back to the question of leverage and investor attitude, which both Lighthouse Capital and Gary Cook have asked about. So let's talk about that. What happens when you get a bubble situation in the economy? Well, What happened back then was that people began to buy South Sea Company stock. And when other people saw that it was going up and it was going up rapidly, they decided to pile in. And you began to get a situation where the valuation of that stock reached unsustainable heights, had no relation whatsoever to its business income. Now, how does that end? And I think this is where the question of leverage comes in. And yes, I think leverage is a big issue. The way it starts is, you get something. Let's take Tesla, for example. Tesla is a perfect example. Something disrupts, something displaces something else. People think it's the next big thing. They start buying it. Price goes up. You get a boom. People get euphoric about it. They start thinking, well, that's just the greatest thing in the world. Look at my neighbors. They're making all this money. And the next thing that happens is that people begin to use the mechanics of finance to try to amplify their gains. If you see a stock that's going up, if double digits every quarter, it makes sense to go and borrow money at, if you can get it at a margin loan rate of maybe 2.5%. I'm not sure what they are because I don't trade on margin. But basically, if you can get margin rates that are good enough, you can justify doing it. But when too many people do that, you get over leverage. And that's one of the things that happened in the South Sea bubble. Leverage works great on the way up, right? It allows people to bid up stock prices because they have access to more money than they would if they were just using their own. But it also amplifies the decline. The critical question is, what's the catalyst that breaks the leverage, that actually reverses the virtuous upward cycle of leverage magnifying price increases to deleveraging, translating into forced selling? Now, one of the things that can do that is just a wave of profit taking. But typically, the most classic examples of deleveraging are simply when there's no more dry powder. In other words, when there's not enough investor interest in buying, and particularly when there's not enough lender interest in lending for leverage. So if you start to see brokerages, for example, raising charges, or they're raising their interest for margin, if you start seeing a withdrawal of that kind of margin and you start seeing a pullback, then that could lead to a cascade. Personally, I don't think that that's particularly likely, because it's likely to be a managed withdrawal of leverage. Now, right now, leverage in the U.S. stock market is actually at its highest level ever. I'm looking at one of the charts that show that there's a $912 billion in current margin debt, which is higher than it was in 2017, 2018. So there's a lot of it out there. But it is starting to pull back slightly. And I think that is for two reasons. One, I think, is because there's a lot more caution on the side of the institutions that provide that leverage capital, realizing that we are getting into dicey territory. They learned a big lesson back in 2008 and 9. But there's a second reason, and I think that has a lot to do with the surge in options trading. Now, options trading has gone into mania. I would say it's almost in a mania type situation. I'm looking at a chart here that shows that the last 2 years, 2020 and 21, have absolutely blown away the last decade in terms of the amount of options trading overall. Right now, recently, we reached a point where average daily trading in options actually exceeded that of stocks. That, I think, has the potential to create a cascade that could tip the leverage part over. Here's how it could work. One of the things that happens when you get a surge in call options buying is that the market makers, those who sell the options, have to hedge by buying the underlying stock, right? They have to make sure that they have the stock, to meet the option if it's called. Now, if they do that, that's going to drive up the price. So you end up with these situations that we've seen repeatedly a couple of times this year, actually, really pretty much every month on expiration day, where you get a big gamma squeeze, where the closer you get to expiry, the more stock prices start going up because you're getting close to the expiry of these options. And that in turn creates what almost look like rogue waves in stock prices that come really on a monthly basis. Now, one of the things that could happen, in fact, it happened in March and April last year, was that a gamma squeeze turns over into short gamma, and that means that the market makers have to dispose of all the stock that they have accumulated as part of their hedging positions, and that leads to a cascade and fall. Personally, I think that's the most likely scenario. Again, it comes back to the self-awareness of the market makers and of the financial system in general. These guys know about this. I mean, they've had the last decade to build up quant models that can see this stuff coming, and they are far more aware of each other's activities, and they know the risk a lot better than they did even 10 years ago. And personally, my guess is that there's a lot of behind the scenes talk about how to prevent a gamma squeeze from turning into a cascade like that. Now, that doesn't mean that it couldn't happen. You could get a 10-15% drop over the course of a couple of trading sessions, but I think that that would be a one-off and not a continued one. So really, that's more a question of ongoing volatility. I don't see at this point the either the leverage issue or the options issue actually causing a collapse in stock prices. But there are other issues. Now, all right, here's another one. Jordan Chan asks another good question. And I can circle back to some of these later if you're interested. Tax reform that discourages stock buybacks. Well, I don't have the figures in front of me, but stock buybacks have had a big impact on maintaining the level of stock purchases over the last decade or so. And in fact, it's been one of the hidden sources of liquidity that, because when stock prices start falling, companies, they look at the risk-free rate, they look at the opportunity cost in terms of the treasury market, they look at what they can get by putting their money in the bank. They say, well, it's a no-brainer, right? Let's buy back some of our stock, let's increase our EPS, our earnings per share, and let's see our stock price go up as a result. Some people say it's because of management incentives. That's something to do with it, but a lot of it just makes sense if you look at the interplay of effective demand for companies' goods, which has been slow over the last decade. We've had a very slow, stagnant recovery ever since 2009. So on the one hand, they're thinking, yeah, we could invest more, but why? I mean, people don't have the money to buy stuff. That's the one side. The other side is the opportunity cost of buying back your stock, which is so low because rates are so low. Now, if you were to start to tax that, I've seen a couple of different proposals, and it looks to me like those would moderate but not end stock buybacks. They would simply make them slightly less financially attractive. Now, if that were to happen, yes, that could remove some liquidity from the market, and that could lead to slower overall growth, but it also lead to probably more volatility, because one of the things that stock buybacks have done is to encourage companies to buy the dip, because they know that if their stock pulls back, they know what their business prospects are. So you see these companies like Apple and others, they say, well, if our stock's down for external reasons, well, we're going to buy more of it, and that brings the share price back up, which keeps it less volatile than it would be otherwise. So depending, I mean, if they made it completely illegal, then we'd go back to the same situation we had before. I'm not sure when it was. I think it was 1989 when stock buybacks were illegal. But again, that would take a while to shake out of the market. But I don't see it, being a permanent end of the market. It would mean adapting to a new policy regime. Whether that would lead to long-term secular weakness in stocks, no. I think still that has to come from somewhere else. It has to come from the real economy. Now, somebody else asked questions about the tax system in general and taxing small business. Yeah, I mean, I think if you were to raise taxes on, particularly small business, yes, I think that could have a negative impact on job formation in particular, because that's where jobs do come from for the most part. I mean, most jobs are created by relatively small business. The question is, would it cause problems if you raise the corporate tax rate, the corporate tax rate, which is the one that Wall Street focuses on? I don't think so. In fact, there's very little empirical evidence that shows that the corporate tax rate makes all that much difference. One of the reasons for that is simply because there's so many loopholes. There's so many ways to get out of paying the official rate. That's big question then is if you raise the corporate tax rate and then close loopholes, then yeah, you could have some issues. But the most pertinent result of that, I think, would be a reallocation or reallocation of capital from environments where corporate profits are or have been financially lucrative but haven't really reflected real economy growth, to sectors where real economy growth is going to drive growth in profits in the future. Let me try to rephrase that in a simpler way. If you're a company that can generate high profits, let's say through setting up a monopoly scenario. The classic moat that Warren Buffett loves so much. If you can do that and create large financial profits that are not dependent on expanding your business operations just by giving you pricing power, then rising corporate tax rates can make that less attractive. If you do the same thing to a company that has a capital offset, in other words, where they can reduce their tax bill by capital deductions, then raising the corporate tax rate encourages them to invest, which gives them the opportunity to grow their revenues in the future, which means that their stocks will become more attractive. So hopefully, the result of a corporate tax increase would be to reallocate capital back to more productive uses rather than just financial speculation and rent seeking. So that's one part of the question. But the second part of it is what would it happen to the small business sector? Now, most small businesses are some form of partnership or a limited liability company or some sort of what we call pass-through entities. Those are basically corporate forms that mean that the owner of the business is paying tax as an individual taxpayer rather than at the business level. Now, the question is, what would happen if you remove some of the incentives? One of the ones that people are talking about is the 20% of partnership and pass-through income that is not subject to tax, thanks to the 2017 tax bill. If you took that away, yeah, that would marginally make those kinds of businesses less attractive. On the other hand, if you were to raise the personal tax rate, if you were to make it more expensive, then that could also discourage potentially people from starting new businesses. But at the end of the day, you're not going to hit those high tax rate levels as a small business person unless you've got a business. So the question is, are you going to stop expanding so that you don't push yourself into the next highest tax rate? Again, I'm not sure. I just don't see the evidence for it historically. The main driver of investment, whether it's at the top corporate level or the small business level, is the perception of potential demand. It's how much you think you can sell, what margins you think you can make, and how much money you think you can invest in the company and take home for yourself. All of the things being equal, if you have strong demand for goods and services in the economy, even at a higher personal tax rate, if you're a pass-through tax player, you're still going to take home more money than you would otherwise. So really, it comes back to demand. Now, the logic behind opposing tax increases is that it discourages new investment, which in turn stops jobs from being formed, which is the classic supply side argument. Again, I don't think right now that is the empirical evidence doesn't show that. I think personally that if we had a more robust economy with higher real incomes, with people able to spend more money on wage goods and wage services, that small business owners, even if they faced higher personal pass-through tax rates, they would probably end up investing and growing their businesses simply because they'd be making more money. Now, again, because so much of the stock market excludes, well, pretty much all the small businesses, again, that doesn't make a big impact on stocks. But it does potentially mean that we could see, as I said earlier, a reallocation of capital from companies that are primarily about financial engineering to companies that can use money to grow their own businesses if they get a capital offset, which, as far as I know, nobody is talking about taking away. Clint says, America can't pay its debt, the debt ceiling on the 18th of October. What would that do this far? That's a good one. And one of the reasons why I think Wall Street has kind of brushed this one off is because they know how catastrophic the result would be. It would be beyond catastrophic. It would almost be as though, I was reading today earlier when I was prepping for this, there was an article in Barron's with three people, Kathy Woods and what's his name, Mohamed El-Erian. And then the third guy was Scott Minerd, chairman of Guggenheim Investments. And he talked about what's he worried about? Well, his biggest worry, Scott Minerd, was the potential for the global payment system to be hacked and to crash, which would basically stop money from moving around the entire world. It would be like, Armageddon. That's what would happen if the federal government stopped paying its debt. Let's just explore the scenario here of why that would be so catastrophic. Yes, boy, if you really thought that was going to happen, if I really thought that was going to happen, you'd have to get out of stocks, at least in the short term. or at least basically be prepared to see them go down to the toilet and then bounce back again once the sanity remains. Here's why that'd be an issue. First thing that the experts on this say is that, let's say the government doesn't roll over its treasury bonds. Let's say that Congress says, no, you can't issue any more treasury bonds. Then the bonds that mature on day one after the debt limit expires would be on the books, and you would not be able to roll them over. Now, what happens? Well, one of the things that you could do is that the financial system could simply mature those bonds to the next day, and the next day after that to just wait and see if Congress would actually, extend the limit, and at that point, then they'd be rolled over. But there's no mechanism that provides that to happen. You'd have to have people sitting down manually adjusting the maturities on all these bonds out there because they couldn't get rolled over. Now, nobody would be doing anything else other than that if that happened. The second possibility, and this is even weirder and potentially even more catastrophic, is that if they didn't do that, if there simply was no way to know when the bonds were going to get rolled over and you didn't adjust their maturity, they would simply fall off the system, because all the computer systems are set up that if a treasury bond's maturity date has passed, it ceases to exist. So basically, you'd have all this liquidity, all these assets falling out of the balance sheets of financial institutions around the world because those bonds cease to exist and nothing rolled them over. Imagine what that would do. That would be absolutely catastrophic for the stock market. And that's precisely why nobody expects it to happen. But it's a good reason why the stock market is going to be difficult between now and October 18th, because, Lordy, given the way Washington is behaving right now, I mean, if you've basically said, one party has said, we will not participate in doing this. The other party doesn't seem to be able to organize their way out of a paper bag. So, this is a pretty risky scenario. So my gut feeling on this is that no, it won't happen. But between now and then, people are going to start getting nervous, particularly if there is a protracted negotiation that comes down to the wire. Yes, we could see a big October dip as a result of that. If I turn out to be wrong and they do this, then I'll see you on the other side, folks, because I literally don't know what's on the other side. That's going to be difficult. Now, I want to remind you to keep submitting questions and to try to, prompt me, challenge me on anything. I've said a lot of things here. I want some pushback here. Basically what I want to know is, what do you think? I've given you some ideas. What I think generally, I've said, there are threats on the horizon, but right now I don't. I see most of them as being manageable. It's a riskier environment than we've been in for a long time, but it looks like the major players have learned to manage that risk. Matt Panos writes in and says, I thought there was a debt ceiling deal to extend to December 3rd. Unfortunately, Matt, that's not the case. What happened was there was a spending deal. What's happening right now in Congress is that you've got two major pieces of legislation. One is the infrastructure bill, and the other is this so-called $3.5 billion spending package. That $3.5 billion spending package is the budget of the federal government of the United States. This is what the Democrats have proposed, and it's what they can't bring themselves, together to agree on. Now, if that doesn't get passed, then you have to have a stopgap spending bill to get you through, because you don't have any current spending authorization, and that's the one they just passed. So now, let's say that you have this stopgap spending bill, which says you can go ahead. Congress has authorized money to get us through to December 3rd. Well, what happens on October 18th is that even though Congress may have authorized the spending, there's actually no money left in the Treasury's account, because Congress hasn't authorized an extension, upward extension to the debt limit. So that's why the debt limit can still come into play. I hope that clarifies it. So right now, I think that the big issue is whether or not this gamesmanship, this brinksmanship is going to continue. So there it is. Here is a question from Neil Topless. He says, will it crash crypto too, or send it to the moon? And I think that's a good question, because what you're really saying there is, Neil, has cryptocurrency become an alternative asset, a hedging asset, or does it depend on the same dynamics that drive stocks up as themselves? I don't know. I mean, history basically suggests that right now, cryptocurrencies are functioning more as speculative assets than as genuine hedges. They certainly don't seem to move counter-cyclical to the stock market in the way that, say, gold would. So my gut feeling again, and this is a gut feeling based on just if worse came to the worst, my sense is that a lot of people would liquidate crypto because they need cash. If the stock market were to start to tank for whatever reason, let's say it's because of the failure to raise the debt limit, I think a lot of people would liquidate crypto holdings in order to generate cash to meet margin calls, and you get cross asset problems going on. On the other hand, I think gold would probably take off like a rocket. And you'll probably see, I don't have the gold price open in front of me, but I know it has picked up recently. And my guess is that you'd probably see gold inching upward between now and October 18th, particularly for that reason. But I think it's a good question to ask. I mean, is crypto the hedge that the true believers want it to be? Let me just call up the gold price here and see what it's doing at the moment. Right now, it's 1759 per ounce, which is a stock value. What I want is the flow value, my friend Clint, and the flow value for gold futures is actually not all that positive. It's only up by 0.5% over the last week, although 20% of that rises today. So right now, gold has not started to exhibit that move toward hedging that I was talking about, but it has started in the last week. It's just begun. Over the last 4 weeks, gold's actually down by nearly 4%. The big issue would be if we get within 2 weeks of that October 18th, then I think you'd start seeing gold up. But my gut feeling is that you would see people abandoning crypto, for at least smaller players would abandon crypto in order to generate liquidity, because I think people play in both markets. I mean, particularly if you had options trades that were going south, if you had margin calls happening, then yes, I think you'd have that problem. All right, let's see what else we've got. We've talked about. Here we have one talking about illegal activity in the stock market. I'm not sure what you mean by that. It's a question from Ulysses Rabiero, but I think Final says crypto equals tulips. Well, Finn, I'm not sure. Maybe time will tell on that one. I still think crypto does have a lot of. I don't think it's the end of the day for crypto. I think my personal opinion on crypto is that things like Ethereum that are linked to a universe or to an ecosystem that generates value in itself. Now the platform generates value, because you can use that token to do something on the platform. Those are winners. Pure cryptos that are just supposed to be another means of currency, not so sure. So anyway, so let's go back to the question of illegal activity. There's an interesting article that came out in Barron's the other day. And the big question there was about insider buying, and apparently it's rampant, even though it's illegal. Personally, I don't think that has much effect on overall stock levels at the margin, but certainly it does indicate that to the extent that the market is not a fair market, yes, there are many issues there. And if you did get a crackdown by the SEC, not just on that, but on other things as well, Clint is saying, what about the demand and supply for equities? If you did see the SEC, the Securities and Exchange Commission, intervening on the supply side of the equity equation, in other words, people issuing equity and cracking down on some of the dodgier parts of it, that could have a big effect. So let's talk about what that is. I mean, essentially, when you have a frothy market, demand creates its own supply, right? The old Say's law says that in the economy, supply creates its own demand, because businesses invest and, they create wages, which in turn, means that people are going to buy stuff from that business. But in the equity market, it's the opposite. When people want to buy equities, you see a jump up in equity issuing. And that's what we've seen this year. I forget the chart that I showed a couple of weeks ago in my Friday video, but essentially towards the end of 2020 and the beginning of 2021, we saw all-time global or all-time historical highs in the issuing of new equity. Now, where does that come from? It comes from companies diluting. It comes from traditional IPOs, and it comes from the SPAC phenomenon. And as you know, the first one hasn't been such an issue. People don't want to issue dilutive equity if they can avoid it. Some companies do, particularly in sectors where that's a good it's a good model, like in real estate investment trusts. Issuing new equity allows you to raise capital cheaply and all that kind of stuff. But for everybody else, IPOs and SPACs are essentially pumping equity onto the market. Now, why would you want to do that? Well, one reason you can do it is by saying that you want to, you've got a great company, you've got a great product, it's gonna beat the world, it's a new, better mousetrap, and you want people to invest in it so you can have capital to develop it and they can make more money. Now, that happens sometimes. But the other thing that has happened a lot in the last year, as we know, is that we've had an explosion of SPAC, special purpose acquisition companies. Now, personally, I think that we've already seen the beginnings of a collapse in that bubble. I think if I look at this chart that Clint just showed me, SPACs the last 2 years, 2021, are higher than all previous years combined, I believe. Now, what has that done? That has flooded the market with new equity that has called forth buyers who have pumped money into the stock market. And surprisingly enough, I do have a chart, which unfortunately I can't show you, but what it shows is that the inflows of equity into the US stock market in the first half of 2021 were bigger than all the inflows into the stock market over the previous 20 years. Now, part of the reason for that was because there was a sudden burst in supply of new equities that called forth people wanting to buy them. Now, Susan Emig writes in, and it's just, as she says it very simply, she says, SPACs didn't work for me. Well, I can tell you, Susan, they didn't work for some of us either. We have a couple of, or at least there's at least one in the Bauman Letter portfolio that I know was a bad decision to buy. Some of you out there know exactly what it is. I know some of you are starting to play that particular stock at the bottom and making money on it. Bully for you. But a lot of us have got burned by SPACs, and here's the reason: because option two, besides listing a company which you know is going to make the next great widget and selling that opportunity to investors, option two is you just talk bull. Almost slipped into censorable stuff there, but basically you tell people things that aren't true. Seen a lot of that, and that what happens then is you get people buying these new issuances of equity at inflated prices, which means that this money gets pumped into the market, but then that money essentially evaporates. The people who were on the selling side of those transactions get to keep the money. Those on the buying side lose all that money, and that's happened to a lot of us, probably like Susan as well. Now, that, I think, is a slow motion collapse that's already in motion. I haven't seen the overall SPAC index. Maybe Clint, lurking in the background there, can find that ETF. I think it's called SPAK, and see what it's done this year. But essentially, SPAK was an ETF that was tracking let me see if I can find it. Yeah, here it is, SPAK. It is down. Let's see if I get the last quotes. It's down 13% on a year basis, and down 12% on a 2-year basis. And what that tells me is that whereas the market has actually risen, I forget today's level for the S&P 500, SPACs have actually had their own slow motion collapse already. And I think that this is, again, it goes back to something that I've talked about a couple of times in relation to the debt limit, in relation to margin lending, in relation to the options market. I think that the big players on Wall Street, in cahoots with the Federal Reserve and probably other central banks, are far more aware of these systemic risks to the market than they used to be. And I think they were particularly reminded of that when there was that collapse of, I forget the name of the private equity or the family office firm that collapsed earlier this year, by using equity swaps, to hide this activity. The market is just as afraid of these financially caused catalysts that could cause the market to collapse as anybody else. They're probably far more aware of them than they have ever been before. And then at the end of the day, that means that at least the possibility of a catastrophic collapse is lower. Now, a catastrophic collapse, could come through a couple of things. One is RT. RT just wrote it, and he's talking about the artificial drama and the budget. And you're right; they do need to get spanked and then fired. But what are you going to do? You got to have a Congress. So yes, I've already said that I think that would cause a catastrophic collapse. But I don't see that collapse coming from the financial system at this point. I believe that the attention to detail in counterparty risk is a lot greater than it was 15 years ago and just before the great financial crisis, because people realize what the risks are. So that means that the biggest risks are going to come from somewhere else. They're going to come from something like policy, like the government's failure to govern, as we're seeing. It could come something like a new viral outbreak. It could come from something like a global conflict, U.S. versus China, maybe Taiwan. But the more likely scenario, and again, I'm just, I've been talking here for 45 minutes, and essentially what I've said is I don't see any of these threats causing a big collapse. And that's because what I've said recently, and I've said it in a couple of different formats, is I see the stock market simply slowing down. Um, I did a study recently where I looked at the growth of the stock market over, there was a chart that I saw that showed how many years the stock market had grown by what percentages, and how many, how that, played out over the last 200 years of the stock market. And one of the things I found was that when I ran the numbers, that having 2 decades in a row of growth that exceeds 15% on average, compound annual growth in the stock market is extremely rare. And we've just had 2 of those in a row. So the big question is, are we likely to have a third? And I think no. And I think everything that you guys have raised, I think the potential for higher interest rates, Fed tapering, the likelihood of marginally higher taxes, the possibility of more regulation on different parts of the economy, all of those things will probably lead to less speculative activity. If Gary Gensler gets his way, who knows what could happen to cryptos. But that doesn't mean the stock market, that you won't still get gains. It won't mean that we'll have a 29 style collapse or anything like that. Instead, it just means that you're going to struggle to eke out gains in excess of the long-term average, which is about 8.5 to 9%. Instead, you got to do your homework and find the stocks that are going to, give you better growth, and that has to come from fundamentals. The wild card in all of this that I've been saying, I think, is the real economy. And I always come back to the real economy because I'm a firm believer that ultimately that is the long-term determinant. When the stock market gets ahead of itself, when we see high PE ratios, high price to sales, you see all this stuff, it means that speculation has got out of hand. And ultimately, it's brought down to earth by earnings. Now, maybe slower earnings will continue to peel back. We'll see a derating in price to earnings ratios, across the stock market, as we've seen all year, particularly in small caps. But the more likely scenario is simply that we see this slow growth in the stock market, with some sectors growing rapidly, things like green energy, things like EVs and all that sort of stuff. But the much more wild card black swan problem is if there's a global recession. In other words, if there is a severe pullback in global economic activity that guts earnings, which leads to stock prices to fall, where could that come from? Well, one of them could be, as I said, a U.S.-China conflict. Another could be a conflict in the Middle East that leads to an interruption in energy supplies, which, although it's not as important as it was back in the 70s, is still very important. A third one could be a big problem, a geopolitical conflict, or again, maybe some sort of a viral problem, particularly in South and Southeast Asia, which is increasingly absorbing a lot of the manufacturing activity that is leaving China because of heightened risks there, and also because wages are rising and making it less competitive. And then, of course, there's the Chinese property market itself. If that were to collapse for some reason, and the Chinese government couldn't sustain that, all of those things could cause a short-term global recession, followed by rapid de-risking, or rather derating, and that cascade of selling, which leveraging provides. Question is, which of them is most likely? My money in the short term is on a steady state punctuated by some scares, but managed by the powers that be on Wall Street and the global central banks to try to avoid a rapid decline and try to have it a managed deleveraging, a managed derating of stocks, lower PE ratios, which we've already seen. I mean, this year has seen a lot of derating, particularly in the small cap space. I was looking at Zoom the other day. It's back to where it was almost like in August last year, right? All of those stocks have pulled back from their highs, and that's a good thing. And I think that's what we want. That's what you want to see happen, because they can't stay that high. That's where at danger level. Beyond that, the black swans, the most likely black swan for me would be probably something at the geopolitical level, and whether that means the United States or the United States versus China, or some catastrophic event in the Middle East or Europe. Those could cause a big pullback in stocks. I don't see the financial sector as being the source of that at this point. Now, it's happened before when people said, we don't think it'll happen. It's looking good. Remember Alan Greenspan saying everything was great in the 90s, and then what? Well, that could happen again if there's something hidden here. My point is that the incentive to find those hidden things is so widely spread across the financial system that could actually, I rate that as less of a problem. So I see the black swans as being the issue. Now, we're getting close to the end. There's a couple more questions. Well, one question is coming from Anantrai. He says, shall we stay invested or exit? To stay invested, what kind of stock shall we buy? Sign up for the Bauman Letter, my friend. That's where I recommend stocks. Now, some of you who are subscribers will probably ping me on this and saying, yeah, but they're not all going up. Well, that's a short-term issue, isn't it? Because of the issues that we've seen this year. So the simple question is, no, don't exit the stock market. Buy stocks that have strong fundamentals, stocks that have secular growth trends behind them, stocks that have good balance sheets, that have strong growth. If they're not making a profit now, you can use something like the 40% rule. If their revenue growth plus their operational margin growth is equal to 40%, then they're a good bet. All that kind of stuff. That's the stuff we've used for the last couple of years to find good companies. On the other hand, I would stay away from risky speculative stocks, but that's exactly what people have done all year, and they've done it increasingly in the last couple of weeks as interest rates have edged higher. So, in a sense, I would say, and I'm trying that don't ever liquidate your whole portfolio. I mean, if you're invested particularly in dividend payers and in companies that have strong long-term growth, in other words, if you operate like Berkshire Hathaway does, keep part of your money as mad money to invest, in the speculative stuff. You don't need to exit the stock market. You just need to have a long-term perspective. The last question comes from Phil Al, who's been a great supplier of questions today. He says, what about the failure of FANGs dragging the rest of the market with them? Well, first, the funny thing about the FANGs is that to a certain extent, they have actually justified the faith that investors have put in them. And that's something that I probably should have thought about earlier. We know that the top 5 or 10 stocks in the U.S. stock market right now, I forget, are accountable for something like 25, I think maybe even in excess of 25% of the total market capitalization of the S&P 500. And that's unprecedented, or at least it's been a long time since that happened. It hasn't been that way since if I'm not sure, probably during the 80s or early 90s. Now, the big difference between now and then is that those companies, when they got that overvalued, a lot of them were companies that were on the end of their growth pack. So, for example, ExxonMobil back in the 90s, when big energy corporations were, still, colossus bestriding the world economy, that was the end, or towards the end of that, because ever since then, we know that we've seen decarbonization initiatives, et cetera, et cetera. So when those companies started to lose that status, then yes, the stock market pulled back, and it took a while for everything to recover. And then we got the dot-com boom, which was in a sense an attempt of the stock market to look for the next big thing, and they were just premature about it. The thing is, if you look at companies like Amazon and Google and Apple and Facebook and all these other companies, they have grown their revenues. I don't have the figures right in front of me, but one of the interesting things that I'm just looking at my chart for the FANGs is that most of these companies are at fundamental pricing levels that are not all that bad. I'm looking for price to sales. The only one right now, or the only 2 companies in the top, if you include NVIDIA, the only 2 companies of Apple, Google, Netflix, NVIDIA, Amazon, Facebook, and Microsoft that are trading in excess of 10 times price to sales are Nvidia at 23.5 and Microsoft at 12.8. Now, that means that right now, if those companies can maintain that rate of revenue growth, then those companies will continue to be able to raise, or see equity price gains going forward. Now, you may see some derating. You may see their price to earnings ratios fall. And just to go back to my chart over here, yes, most of them are pretty high. Amazon is 57, Netflix is 63, and their price to earnings growth, the PEG ratio, which is my most important one, the only one that's below 1 is Facebook. So yeah, some of those stocks are overpriced right now, but they're still growing. So that means that their price to book, and particularly their price to sales, is still reasonable, and that's what you want to see. So I don't see them failing as bringing the market down. What I do see is a gradual derating. In other words, they're pulling back those price to earnings ratio, and that would in turn remove some of the excess energy from the market, in the same way that somebody, when they asked earlier about the potential for a taxation on buybacks, that could all do that kind of stuff. So again, I don't see that as destroying the market. It just means it's going to slow down. Now we're coming close to an hour, so I'm going to leave that as my key message here. I think the market is going to see lower overall index level gains going forward, but I do think that we're going to see big gains in the sectors that have genuine secular tailwinds, things like green energy, things like electrical vehicles, artificial intelligence, new modes of transportation, even beyond artificial intelligence. I think there's still a lot of room to run, particularly in electronics and in microprocessors, because we're moving in the direction of new kinds of potential microprocessor manufacturing technologies that could get around Moore's law. In other words, there's a lot of people talking about new ways to make chips that could potentially make them thousands of times more powerful. All that stuff, that's what you call secular tailwinds. I think healthcare is a secular tailwind because of aging populations and new disease stuff. We've invested in a couple of healthcare companies. In fact, we had one pop this morning because of recent news on that front. We made a good call for once. And all of those things, I think, to go back to whose question was it, and sorry, that's where you want to put your money. Keep some of it for these short-term frothy things like the ones that we've seen since COVID came on board. But remember, everybody, the financial system, the banks, the central banks, all of them want to try to deleverage the global economy away from this dependence on high interest rates. Whether we like it or not, they're going to do it, because if they don't, we just don't have a way forward. So all of that means slower growth, but if they can get it right, hopefully it'll be steady, and we'll have to look harder for gains. Anyway, thank you very much. We've come right to 1 hour, so I'm going to go ahead and sign off. Thank you very much. Please leave comments if you'd like to see new topics for me for these live things in the future. I really hope next time I'll be able to show you some graphics, because I want to be able to show you the evidence behind what I'm saying, and it's difficult sometimes when I'm just talking to you, but hopefully next time we'll do that. Anyway, this is Ted Bauman and Frank Zappa signing off.